Hello, everyone, and welcome to today's webinar, 3 Ways to Avoid the Next Market Crash. Today's about learning how to protect your money from the rough times and grow it in the good times. And I'm not here today to give you unrealistic expectations and convince you that you're going to make $1 million overnight. That's not what we do. What I am going to do is teach you how to potentially save tens to hundreds of thousands of dollars over your investing lifetime by avoiding market crashes like those during the COVID crash and the GFC in 2008. These are even skills that you can teach your children if they're investing or thinking about investing as they go along. Now, before we get started, I just have to point your attention to our financial services license, which is just to say that what I go through today is more general in nature and shouldn't be taken as advice as to which shares to buy, hold, or sell in the market. And of course, that past performance is not a guarantee of future performance. Okay, so as promised, I'm going to share with you 3 actual ways that you can avoid market crashes, but I'm also going to show you the other side so you can still take advantage of the good times to grow your nest egg much bigger over the long term. Right now is a great time to learn and get skilled up so you can take full advantage of the bounce that comes after this volatility subsides. After this session, you'll be able to walk away and implement these 3 things yourself today with your own portfolio. I'll also cover a really simple process that we follow to implement them too. Does that sound good? Great. I'm excited to show you how it's done. So my name is Shane, and I've been showing people exactly how to get the most from their investments here at Sharewell Systems for the past 15 years, or almost 15 years in December. I follow the exact same strategies with my own personal portfolio and my own self-managed super fund. So I live and breathe this stuff and I use it for my own money. So what we do at Sharewell Systems is we time the market, and I'll show you how we do that shortly. But you might be asking, what's the benefit of timing? After a stock market crashes, it usually recovers, right? So why not just buy and hold and accept that sometimes your portfolio is going to pull back? Well, this is what timing is worth. And let me just move my head out of the way a little bit there. Okay, this is what timing is worth. In the past 7.5 years, by using timing and following a really clear set of buy and sell signals, our SPA3 investor portfolio has grown 152.02%. The market, the All Ords in this case, over that time is up 47%. That's a huge difference of $91,000 in just 7.5 years that it's been running. Now, if we added dividends to the All Ords, that does add about 4% per year to its performance as well. But do you see the flat spot in the portfolio here during COVID? This is where we moved 100% to cash and protected against the rest of the fall. And that's what today's all about. This is a real money live traded portfolio where every trade is transparent for our members to see every single day if they want to. And now you might know that we have 2 systems. One is called SPA3 Trader and one is SPA3 Investor. SPA3 Trader is our more active system and it's been out since 1997, but it does take a lot more effort and time, and you will see more volatility over that period of time. I'm going to cover a bit of both systems today, but the idea of SPA3 Investor, so we had Trader out since 97. In 2015, we went about devising a system that was much more focused, one where investors spent less time managing their money and actually traded a lot less. And that's how SPA3 Investor was born. But we don't just release something and hope that it's going to do well. We had to research it for a very long time, actually about 6 years, to make sure it would work through all different types of market conditions. So with SPA3 Investor, the research went back all the way to 1998. Now, my apologies for the blurriness. This is a bit of an old screenshot that Google didn't tend to like. But this was the research. So we went back all the way to 1998 so we could see how it performed through times like the GFC here, the tech crack in the early 2000s, and the varying bull runs that the market has had. Over that 17-year period from 1998 to 2015, just before we released it in 2015, had we been following the rules, a $100,000 portfolio would have grown to 1.544 million. Now that's research, that's a simulated portfolio, but in comparison, buying and holding over the same time leaves you with $1 million less in your portfolio. Again, that's the big benefit of timing over just buying and holding on through crashes as well. Saving on crashes is going to save you a lot over the long term. Now, with 23 and a half years of history in both researched and live traded portfolios through all different types of markets, we can pretty much be confident how SPA3 investor performs over the long term. And that's the idea of doing the research. Sometimes the portfolio will pull back, other times it'll go sideways, and then other times it takes off and overall it outperforms. So there are three big benefits to timing this way. The first is that it won't let your portfolio fall 50% in a GFC type crash or lose 36% in the market like COVID did. The second is that it can help grow your portfolio more over time by moving your money to the areas of the market that are performing and avoiding those that aren't. And the third is that the journey along the way is a much less stressful journey because you're riding more of the ups and you're avoiding more of the downturns. We want you to be a peaceful investor and enjoy the journey along the way, not a stressed investor always worried about what might happen to your money. And if you're worried about market crashes, you are going to be stressed at times. Okay, so before we get into the three ways to avoid the next market crash, I want to ask you how you're feeling about the last few weeks in the markets. What about what might happen over the next few months with continued inflation worries? I know it's subsiding a little bit, but are you completely confident in your strategy, or you're a little unsure of what to do from here? I've spoken to a bunch of people that have missed the run over the last year because they were just not confident and they stayed out of the market in cash because they were worried about what might be coming. It definitely has been a testing time for some, and it'll be interesting over the next few weeks and months to see how it's all going to play out. Now, I say interesting rather than worrying time because our customers aren't worried about what's going to happen. They have really clear sell signals to get them out if the stocks that they're in do take a turn down. Just like on this chart of James Hardie over the past couple of years, you can see where it got out and missed most of the 50% fall last year. And then 12 months later, when we were out of it for 12 months, it's given another buy and is currently up about 42% here. Got to keep moving myself there. And that's going great. And when you have signals guiding your every move, you can be confident in all your market decisions because you know that you're protected from the worst happening to your money. Now, right now with James Hardie, we know exactly where we stand. So where we stand with James Hardie is that if it falls below this red line that you can see on the chart here, that's our leap timing indicator, currently sitting at $43.15. We'll get our exit signal and we'll sell out. Having a clear Having a clear exit strategy is not something that we talk about with the benefit of hindsight. This is something we talk about all the time. It's why people come to us. Plenty of people out there will have an opinion on what to buy and, what to hold or, what's going to be the next big Amazon. Not too many of them are going to tell you exactly when to get out. That's what we do. And that's why people come to us. Now, you might have seen some of the interviews with our members thanking us for getting them out and protecting their money during the last crash, which was COVID a couple of years ago, or 3 years now. So here are some of the examples of those. And you can see a whole bunch of testimonials on our website as well. But in the office, we use the system too. I'm comfortable with my investing now, but I wasn't always so confident in my decision-making process. When I first began, it was an entirely different story, and it cost me a lot for that time of my life. Basically, I blew up my first $25,000 portfolio. What was happening at that time, I held on way too long to stocks that I probably should have sold, that I definitely should have sold. I bought stocks on their way down, trying to catch a falling knife. I used leverage way too much, using CFDs and the like. And I tried to chase my tail when I had losses as well, hoping to make up for those losses, but really only made it worse. It was a pretty rough time, and it wasn't fun telling my wife what had happened afterwards either. If you've ever had that conversation, it's not too much fun, is it? Now, after speaking to so many investors over the past 15 years, I can tell you that most people do have a similar story. I'm sure you can relate to that. Some people learned a lot quicker than me, which is not surprising, and others did lose a lot more as well. But almost everyone has gone through that as well, where they didn't know when to sell. They held on too long. They didn't buy when they should have bought in, and they missed an opportunity. Personally, I think I was probably lucky that I didn't have more money to spend at that time, as I probably would have lost that too. So if you're in the market right now, I've got some good news and I've got some bad news for you. So let's start with the bad news and get that out of the way. The bad news is there's going to be another crash, 30 to 50% sometime in the future. And most average investors are going to get caught out again and lose a whole bunch of their money. The good news is, though, that you can learn from it. And with the right tools, you can actually avoid it the next time that it happens. As I said earlier, you can use these big market moves to your advantage to grow your portfolio much quicker over time, and maybe much quicker than you previously thought as well. So this doesn't mean that you have to continually keep buying more stocks as the prices fall. That can be a recipe for disaster, as I'll cover in a moment. And I'm not talking about watching the market like a hawk, spending hours a day trying to perfectly pick the very bottom and the very top of every market to always be profitable. That's impossible, right? But we all know that markets move in cycles, don't we? After a crash is done, we often see a big rise. So what I'm talking about is really using those market cycles to take advantage and make your money work harder for you. Does that make sense? These cycles are, such a big part of the three things to avoid the next big market crash for your portfolio. Okay, and this is the secular bull market. This is the long-term cycles in the market, but you also have shorter primary bull and bear markets within these larger cycles, which are these shorter periods of time through the middle here as well, where you get those seemingly ranging markets on this big one, but when you're going through them, they might last a year or two of these primary bull and bear markets too. Okay, so here is number one. Simply avoid market crashes by getting out and protecting your capital by having it sit in cash. Just sell and get out. Obvious, right? Easy and really simple, right? Well, maybe not quite that simple, as some of you may already know. What I mean by it is really that you've got to have a rule in place that gets you out without hesitation. Something so clear cut in the heat, something so clear cut that in the heat of the moment, you don't get stuck saying, let's just wait and see what happens. I know we're going back a few years now when I'm talking about COVID, but those of you who went through that and were in the market, do you wish you sold before the crash? And when the news initially broke about the pandemic, instead of just waiting and saying, I'll just wait and see what happens? How were you feeling when the market was in free fall? Were you nervous? Were you uncertain about the future? It was a tough time, wasn't it? Recently, it's been tough too, kind of up one day and down the next, or down 2 days and up the next as well. What history shows us is that buy and hold or wait and see in the wrong situation through a big market crash can potentially result in devastating losses. Especially if you don't have a spare 5 to 10 years up your sleeve to wait around until you get back to where you were. If you're close to retirement or you're in retirement, you don't have that 5 to 10 years just to get back to recovery as well. The All Ords itself, if we look at the market as a whole, took 11 and a half years to get back to where it was after the GFC. That's a lot of time just to be trying to get back to where you were. The unfortunate yet common mistake is people tend to make first time around is that they wait until after they've been through a big crash and lost a lot of their money before they learn their lesson, just like I did. Now, I wasn't in the GFC. I was after the GFC, but I still made a lot of mistakes as well. And it took going through those mistakes to come out the other side and work it out, that you've got to have rules. Up until that time, it's really easy to be complacent with your portfolio because you don't know any better. You don't know what you don't know. Making money seems easy up until that point. So take it from me, you're going to be years ahead if you can avoid this the first time round, and your significant other is going to be much happier with you too. As I said, that wasn't a fun conversation. The easy solution is to learn from other people's mistakes and be prepared for it first time around. Now, there are a number of strategies that you can adopt in order to protect your capital. You could use a certain percentage when the overall market itself pulls back, maybe say 7%. If the market pulls back 7%, you sell everything and you move to cash. If that was your strategy, you would have protected nicely when the market fell 36% during COVID, wouldn't you? And you would have protected nicely during the GFC where the market fell 54%. Of course, you then need some sort of trigger to get you back in when the time is right, but that would definitely prevent a 30 to 50% fall in your portfolio, wouldn't it? Now, I'm not saying 7% is the golden number by any means, but it's a trigger that you could use to get you out and protect. For your portfolio, you might be more risk averse, or you might be more tolerant to risk as well. And you might be comfortable with, say, 10 or 15% instead, or maybe only 5%. The number's going to be different for everyone and their own risk tolerance. But it is a rule that you could set today to keep you covered going forward. You could also use some sort of technical indicator that you're confident in following, and then act whenever it says to sell, and then get back in when it says to buy again, of course. Now, some sort of technical indicator might be a moving average crossover, a MACD, swing chart, ATR trailing stop, or something else. They're all reasonably common ones that people could use. Or you could use something like a spike on the VIX index as your market barometer. Now, there are a whole bunch of different ways it can be done, but the important thing is that you actually do have something to get you out and protect that you religiously follow every single time. It's no good having a thought in your mind that you might get out, but then when the time comes, you end up changing your mind and your portfolio gets smashed because you didn't act. That's not going to help you. You need something set in stone that you're going to follow every single time. Is there something you're already using to do this, or are you currently a little bit exposed? And if you are exposed, do you think it might be a good time to consider changing that with everything that's going on in the world? As an example, in SPA 3, what we use, the change in the market trend is what we call a high market risk and a low market risk. It's kind of like, as I said, an overall barometer on the market and how it's going and the market sentiment. Here's what it looked like during the GFC. For the high and low market risk signals, we use the All Ords Index, which is, for those of you who don't know, the All Ords is an index of the largest 500 companies on the Australian market. Okay, so, and we use this high market, low market risk, mostly on SPA 3 Trader. Now, if the All Ords has an entry signal, like you can see down the bottom of the chart here, it's considered low risk, and that's the time you want to be in and investing. That's when you want to take advantage of the uptrend. If the All Ords has an exit signal, like you can see here or over here, and it's starting to fall, it's considered high risk, and you sell, letting your money sit in cash, protected through the big falls. Is it perfect? Of course not. Sometimes the price is going to break out only to retrace again. That's the market. We can't control the future. We don't know the future. But if that does happen, we have the signal in place to get us out so we don't take huge losses in the big market crashes. And also, here's what that looked like in COVID. As an investor, you can handle small losses, right? But you don't want to tolerate losing half your money because you didn't get out in time. Does that make sense? Okay, great. So that's number one. Well, number two is pretty similar to number one, really, except that it relates to individual stocks, not the overall market as a whole. So number two is that you've got to have an exit signal to sell your individual stocks quickly. Because have you ever bought a stock, watched it go up and said to yourself, think I should sell, but I'll just wait and see what happens tomorrow? Then been stuck like a deer in the headlights as you watch your profits or your portfolio go down the drain? Anyone got some of those in their portfolio right now? Stock like these that you can see on the screen here, they were once market darlings. They couldn't put a foot wrong, but they've now been smashed. They're the constant reminder, if you've got those in your portfolio, of that time that you messed up. It's pretty hard to sell them when they're way down, isn't it? So they just sit there reminding you every day of that time you messed up. As I mentioned earlier, I did this a bunch too before I learned that I needed a clear, unambiguous exit signal. The idea of an exit signal is about getting you out of the way from yourself. We're human and we're often driven by fear and greed. And at times we make silly emotional decisions. And these emotional decisions can be costly both financially and psychologically. Having an exit takes out all the guesswork. It takes that out of your trading day and it helps you to eliminate uncertainty because you can place your trade and know that you have something to get you out. So when the time does come, you sell. And that's it. It's easy and it's unemotional. You think about it on the day you get in and the day you get out. Every day in between, you're just holding on and you're comfortable knowing that a sell will eventually come when the time comes. Just like protecting against market crashes, there are a number of ways that you can exit to protect from major losses in your stocks. Some popular ones, similar to the market, are using a percentage-based exit. For example, if it drops 5 or 10%, you sell the stock. Others are using technical criteria like an ATR trailing stop, profit stop, momentum-based exits as well. And not all sells or exit signals are bad or involve losses. The profit stop is a really good one because you're locking in profit before the stock starts to turn down. I know it's probably pretty small on your screen here, but you can see these little red signals on the chart here. The first 4 on these 2 stocks are all profit stops, hitting the profits on the way up. And then this one was a momentum-based exit. Okay. These basically the idea of these is to lock in short, sharp gains with SPA3 Trader. Whatever combination of exit signals you decide to use for your particular strategy, you've got to decide them before you buy the stock. There's no point deciding halfway through or on the fly. You've got to decide before you go into it. And when the time comes and that exit gets hit, take it. Don't sit around and act. Don't sit around and wait. Act on your predetermined signal so you're not making emotional decisions on the fly in the heat of the moment. Stick to your plan. That's why you have a plan, because without an exit, you will get caught holding on too long and it will end up costing you. And the great thing is when you actually do have a plan and you've got a strategy in place on when to buy and sell, you can just repeat it over and over and over again. Here's the buy and sell on Technology One, and you can see our leap timing indicator is our buy. We hope for the best when we get into it, but it's also about protecting against the worst happening. So if you buy the stock and it does start to fall, then this exit signal is about protecting against it. And then eventually when it does start to fall, we get an exit and we move on to the next trade. And then there was another buy and a sell there, you can see. Okay, some more examples of this. Here we've got Newcrest. There was a sell. We missed the 45% drop, another buy, and up it went. That was earlier this year. Apple, which has had a buy and a sell, and they're not all big winning trades. We do have lost trades too. If you've seen some of our YouTube videos, we show the profit and loss trades in those in short, sharp cliffs, and you can go in and keep track of our public portfolio in there too. But here we have lost trade on Apple. We had a buy and a sell, but we don't continue holding on to it for a 30, 40, 50% drop if that happens. Then there was a buy, had a good run up, and it's pulled back in the last few days as well with the market. Next, we have Nvidia, which I think, again, had a big night last night over their huge profit beat as well. So, they were up last night with big future ahead of them as well. So these last couple were obviously on the US market. We do both Australian and US markets as well. But the idea is the same, regardless of which market you're trading. You've got very clear signals when to buy, when to sell, protecting from these drops and getting back in when they start to rise again. All right. So for number 3, I'm going to tell you a quick story about a member of ours called Jim. Now, number 3 is don't keep buying more and more shares as the price falls without an exit strategy. It's like trying to catch a falling knife and you're likely to get hurt. Now, this can be disastrous because people often keep loading up, buying more and more shares as the price dips. It's often referred to as dollar cost averaging or averaging down. Sometimes it comes back and it works quite well. But if it doesn't, if that stock you get into doesn't come back, it can be devastating. And there's plenty of examples of this happening over the years. No matter how good you think the company might be, sometimes things are out of their control and they just don't recover. So on Jim's been with us for a few years now, for many years now, really. But when I originally showed him SPA3, he told me this story about how he'd been caught up in Forge Group. Some of you might remember Forge Group. It's a story that's always stuck with me. So, and I've told it a couple of times in past webinars too. Now, this is going back a few years because Forge was going back a few years. This is so relevant to anyone who's in the market now thinking about buying more shares on the dip. So I just wanted to tell it again as a bit of a cautionary tale. This could easily be Magellan, Appen, or Zip, or any other stock that you're holding on to. Okay, so Jim had traditionally been more of a fundamental investor, holding on to things like the banks, BHP, and Telstra. However, He bought a big position in Forge Group after reading some positive news about the company and hearing someone praise it on a TV money show. He'd originally bought Forge at around $3.80 here after it had already gone up quite a long way. By $7, he'd almost doubled his money, or close to $7. He almost doubled his money, and he was pretty proud of himself. Now, he thought that if it hit $7.60, where he would have doubled his money, he was going to sell. But as you can see, it didn't quite get there. Now, at this stage, unfortunately, because he had no real exit plan and he didn't sell. And on 3 separate occasions, which you can see with these pinkish arrows here, he topped up when it hit to $4.50. He thought, surely it couldn't get any lower than that. And for a while, he was right. It didn't get much lower than that. Okay. And he thought he couldn't just let it, and he just couldn't let go of that, that $7.60. He had that target in his mind and he was just couldn't let go of it. He was holding on to it. Okay. He was sure it was going to get there eventually. The problem was because he didn't have any real money management rules or exit strategy, after topping up, about 40% of his entire portfolio was tied up in Forge, which was about $200,000 all up. Unfortunately, though, Forge hit a few roadblocks, and some of you may remember what happened to them. The price plummeted from $4.20 to 70 cents overnight, and then had a short run up where he could have sold and maybe taken 60, 70, 80% hit, but instead he got stuck holding and hoping that they'd improve until finally they went belly up, and the best he could do was sell at a loss, or take the thing as a capital loss, I should say. Now, if it was only 10 to 15% of his portfolio, he would have been okay. But because he was now 40% invested in this one stock after continually buying the dip, it was devastating. Here's how SPA 3 dealt with it at that time. Nowhere near the big fall. Here, Jim had made a few common mistakes. He topped up when he thought the price couldn't get any lower, but it did. The topping up had led him to have too much money in a single stock, which is extremely dangerous. And lastly, he'd been wooed by some news story. And as I'm sure some of you know, the news can wreak havoc on your trading mentality at times. Ever been caught out on a news story where you thought it was going to play out one way and totally the opposite thing happened? It happens all the time, especially on company announcements. Yeah, ARB was a classic one just the other day. Had an announcement, price dropped 10, 12% early in the day, and then it pushed back. But it came out of the blue as well. People were buying, and it had a positive day before that. For Jim, these 3 factors were a recipe for disaster, and he paid dearly for it. Now, I know some of you here will have some really large positions in some companies similar to what Jim did. If you're in a stock that you're currently holding that has gone down 30, 40, 50% in the past few months or the last year, why didn't you sell it? Why didn't you get out? Now, I'm not saying that as a criticism. It's just that we're human, and it can be really hard to make that call in the heat of the moment, can't it? There've been plenty of stocks that were once market darlings, like some of those ones we saw before, that have had huge pullbacks. They're the ones you could easily have been caught buying more on the way down, thinking they can't get any lower, only to see them fall further. It's an easy trap to fall into, but it's often really costly. If you're looking at this and thinking, oh, gee, I don't really have a plan in place to get out, it might be worth going back to number 2 and thinking about what sort of exit you might like to use so that you are protected if you are in some of these really large positions at the moment. Okay, so before we jump in to have a look at the system, I just want to reiterate the 3 ways to avoid the next big market crash are: the number 1, don't be in when the market crashes. Simple. Get out completely. Okay, have an exit signal in place that you always stick to is number 2, so you don't get caught stuck holding on when you should get out. And number 3, don't buy stocks that are falling, and don't buy on the dip and keep adding more and more, because they can always fall more. Wait till they start rising again and have an exit strategy in place to get you out of those large positions. And a couple of other points to help, which I just spoke about, are, don't put too much money in one stock, and don't get caught up making emotional decisions based on the news of today. Now, if you want to shortcut the process and fast track your way to investing success and protecting against market crashes with a system that really has the runs on the board, then SPA3 Investor and SPA3 Trader are great options. So let me show you how easy it is to use SPA3 Investor, because we've already done the research for you and tested in all sorts of market conditions, as I showed you before, so you don't have to do it. The idea of SPA3 Investor is to keep your process super simple. And I am going to cover SPA3 Trader too, for those of you interested. It's basically the same process we do with SPA3 Investor and SPA3 Trader. There are a lot of complex systems behind it, but as a user, you just need to follow the basic process. Anyone can do it. And with SPA3 Investor, it only takes about 15 minutes a week. With SPA3 Trader, it's about 15 minutes a day. So SPA3 Trader is a bit more of a commitment. Now, with SPA3 Investor, it's not about getting to the smaller companies to achieve its great performance. It's about focusing on a few household name stocks to beat the market professionals. Also cover some ETFs. Now, normally in your portfolio, you would hold 9 stocks at any given time, and the system will tell you exactly what to buy and when. Now, when you first start buying, you buy on a first come, first serve basis. So when the system alerts you to buy the first stock, you buy that. And then when it tells you the next one, you buy that. So if BHP is the first stock that comes up today, you buy BHP. Then it might be a few days later that Commonwealth Bank comes up as a buy. So you buy that. And then a few days later, it might be JB Hi-Fi or whatever it may be. And you keep filling your portfolio until all 9 positions are filled. Then you simply hold until a sell is alerted. Now, with it as well, we run it as what's known as an equal weighted strategy. So you invest the same amount of money in each stock. Because they're all large stocks, you can do that. It doesn't need stringent money management criteria, whereas SPA3 Trader, it definitely does. So if you had $90,000, you would buy $10,000 of each stock. And if you had $45,000, you'd have $5,000 in each stock. And larger portfolios can hold more positions. Pretty simple, right? Now with SPA3 Investor, there's 2 ways that you can get your signals. The first is to get your buy and sell signals via the Share Wealth Systems Alerts app. So basically what happens with the app, at 8 p.m. each night, you get a ding on your phone letting you know if there are any signals. When you open it up, it looks like this. So in the case here, you can see that on Monday, well, let me go back to that. You can see that on Monday, February 13th, there was a sell on JB Hi-Fi and a buy on REA Group. So if you're holding JB Hi-Fi in your portfolio that time as one of your 9 stocks, you would have gone into the market and sold it. And then you've got some money spare in your portfolio. So you would take that money and you would go and buy REA Group. Again, pretty simple, right? Simple and easy. And that's the whole idea of SPA3 Investor. A lot of the time, what's going to happen is there's going to be nothing to do, and you get an alert like this saying that there are no new signals today. So at least then you know that everything is working okay. All you need to do is hold on to your portfolio. And then you come back tomorrow and you check it again. Now, the second way of doing it is on your computer, is by running a scan on your PC. So here's how you do that. So what I'm going to do is get out of that. And on your computer screen, when you're running SPA3 Trader, you'll see 2 icons. One is Beyond Charts, which is where we're about to run a scan. The other is SPA Trademaster, which is our portfolio manager. Now, the process of doing SPA3 Investor on your computer or doing SPA3 Trader on your computer is pretty straightforward. There are 3 steps. Step 1, you run a scan and it will tell you exactly what to buy, which is what we're going to do here. So on your scan, we're going to run what's called a SPA3 Trader new entry scan. On your scan, you can run a scan for entry signals. So looking to buy, and I'll just kick this scan off so it starts racing. So on a scan, you can run a scan for entry signals. So looking to buy a position. Exits are looking to sell. Pyramiding is you've already got into a trade and it's going along nicely. So it gives you a signal to add some extra money to it. And then a lighten signal is reducing the size of your position. So lightening the load, so to speak. So a lighten can occur if a stock's a little bit volatile, so taking some money out as a precaution, or you've gotten in and it shot up really quickly and you're locking in some profit. Okay. Now, as we can see here, the scan is racing away, looking for across the entire market for SPA3 Trader. With SPA3 Investor, we're focused on large cap stocks. So there's 55 large stocks and 8 ETFs with SPA3 Investor. So here, it's running a scan. Now there's 2,745 stocks. It's looking for stocks that are gaining in momentum on both a weekly and daily basis. It's looking for stocks that are outperforming the market overall, and also looking for stocks that have enough volatility. Now, we want to buy stocks that are moving, but not jumping all over the place. So that's the idea of looking at the stocks for the right volatility and liquidity. So there's enough money moving through it each day. So here we can see we've run the scan. Now I ran it over the last couple of days, and with the volatility in the market, there hasn't been too many buy signals here. So here we've got 4 that have come up. We've got ASG, Hub, PL8, and PRN there. Okay. Now at any time we could click on these and go in to do it. But when you're buying, there's 3 steps to buying. The first step is you run your scan. The second step is to take it to your portfolio. So the way we do that is you click on this little running person and you act on the scan results. Now what that does is it sends it across to TradeMaster, where your portfolio is set up. Now TradeMaster is the money management, the risk management, and the portfolio management tool. Okay, we've also got a portfolio manager housed within Beyond Charts for it as well. But SPA3 Trader, we use TradeMaster for it. Okay, so we've run the scan and we've got our buy signals. The second step is to act on the scan results. Now, the reason we have TradeMaster set up or a portfolio manager set up is it goes through an extra layer of filtering on the money management rules here. Okay, it's kind of like having part of the rules of a trading plan automatically set in place as well. Okay, so on a day-to-day basis, you don't have to think about the rules of your portfolio. The system's already doing that for you, and it allocates positions based on risk of your portfolio, but also the overall risk of the stock as well. So in this particular case, we've got 4 that have come up, and let's say we're starting new, so we could take all 4. Now, the third step is to highlight the stock that you're going to take, and you would click Act On. So step 1, you run your scan of the market and it gives you buys. Step 2, you bring it across through your portfolio manager where it calculates how much to buy. And the third step, it brings up a little ticket really to tell you how much to buy on that stock. So we can see here with ASG, we can see here that it will literally tell you at this time to go in and buy 1,609 shares of ASG at $2.44 each or thereabouts. Taking your brokerage costs out. Now I've just got Saxo brokerage in there at $6.99 for a trade value of $3,932. Now this portfolio is set up as a portfolio of $50,000 and a portfolio risk of 0.9%. Now what that means is that on any single trade, if the trade was to go against us by $450 or less, we're okay with that. If it goes more than that, we're not okay with that. So that helps to determine how much we should be buying in the first place. So we're not taking too much risk with the portfolio. So here, what you would do is you would go into the market and you would buy ASG. Okay, now you might get to the market and the price has changed. Let's say it's gone up to $2.50. And I've got a couple of screens going here, so that's why I'm looking back and forth, if you're wondering. So at $2.50, it'll still tell you to buy roughly $3,930 worth, but it'll tell you to buy a few less shares. Excuse me. Similarly, if it was down at $2.30, it'll tell you to buy a few more shares. You get more shares for your money there. Okay, and then you simply hit commit. And from that point on, it's going to track it for you. It's going to keep an eye on it for you. And in TradeMaster, you can run as many different portfolios as you like as you're going along as well. So if you've got a self-managed super fund, you've got a personal portfolio, you've got a family trust, you can run all of those together as well. Okay, so we've added that. We could add another one, and you just keep adding until all your portfolio is allocated. Now, as it's going along, you can see how it's going. So you can come in and you can see your open trades. I'll get my mug out of the way. All right, so here we can see that if we did buy ASG at that price, we're up $146 and the profit is 3.74%. Had a down day yesterday, but overall we're ahead. Our portfolio has grown from $50,000 to $50,146 there. Now, it will also, as I said, keep track of everything for you. So those of you who are spreadsheeting your portfolios and you're filling them in and updating them all the time, this is going to save you so much time as well, because it's going to update automatically each day and keep track of it all. Excuse me. All right, so here you would have a list of all your transactions for the year, your opening and closing balance, annual return, buys, sells, profit loss, dividends, franking credits, brokerage, all of those things as you're going along, so you can keep it. So at the end of the year, you've got a copy, you can print it off, and you can do that for every one of your portfolios. But as we said earlier, buying's probably the easy part, right? We're talking today about protecting. How do you know when to sell your stocks as well? So the way you look for sells is pretty much the same way you look for buys. The way you protect is the same process. So with SPA3 Investor, you've got the app where it'll send an alert to your phone, or you can do it on your computer. With SPA3 Trader or SPA3 Investor on your computer, what you do is you run a portfolio scan. Okay. We don't want to be stuck holding stocks that we should get out of. So a portfolio scan is going to scan the specific shares in your portfolio and tell you when to get out of them. So here I'm going to run a scan. So in this portfolio, you'll see it'll do a quick run through the 9 stocks, and 2 of them have come up. So that means 7 of the stocks you just hold on to, nothing to do with them, just hold on to them and wait on another day for a sell signal. And a lot of days, this is all you'll have to do. You can imagine if you're fully invested and you run a scan and nothing comes up, nothing to do today. Just hold on to your stocks. It's only if there is a sell, like we can see with Ordinate and Brambles here, that if there is a sell, you simply sell it off, run your scan, and look for another position to fill that spot. But if you like to look at the charts, you can come in here and we can see Ordinate. Now, Ordinate has had some choppy trades. We had a buy, another buy. These are both lighten signals where it'll tell you to sell 33% and then a sell here. So this, from a buy to a sell, was a small little profit along the way, but not a huge profit there. Didn't really go far. Then we had this buy, tracked sideways for a couple of days, and a couple of days later, it jumped up and it hit a profit target. Shares that shoot up very quickly have a bit of a tendency of pulling back quickly. So we'd be selling that and moving on to the next trade as well, locking in the profit and moving on to the next one. Okay, the other one here with the sell was Brambles. Now, Brambles, this was a momentum-based exit. The overall market risk triggered an exit. When we can see the past trades here, there was a buy, a lighten, and a sell. A buy, we can zoom in a bit more so you can see it. A buy, this had a great run up, and then a sell. A buy and a sell, and then a buy and a sell there. So we had a couple of trades that didn't really eventuate, and then we had this huge profit in the middle here. And that's what it's all about. You know, if you get into a trade that doesn't go anywhere, you cut that short. You know, it's either take a small profit or you take a small loss, and you protect from a big loss occurring. If it does buy and has a good run up, you've got the criteria there to let that profit run all the way along as well, until eventually it starts to lose momentum and give you a sell there. Now, if you want to learn all the technical criteria behind the system, it is all there. I have covered it in past webinars as well. But if you do want to see some of that, you can look at it on the charts. Sorry, I'll just drag and drop a little bit on here so you can see it. So this is our daily signal that we use an indicator called the CIROC, which gauges daily and weekly momentum of the stock as well. Has overbought and oversold zone, similar to a MACD or an RSI and other things. But you can learn all that technical criteria. We provide very detailed education. There's our white papers that go through all the research with it as well. We love research. There's nothing in the system there by accident. So we provide all of that as well. If you want to come in and see that, we can come into documents, and there's an education center with videos, step-by-step videos. But if you want to come in and see the research behind it, that's there as well. So here, now I won't bore you going into this too much, but you can see, you know, the kind of research that goes into the system. This is 240 pages. What does it mean to change brokerage? What does it mean to change risk percentages? What does it mean to change the settings in the system from longer to shorter settings, or vice versa as well? And what effect does that have on different amounts of money in portfolios? We research all of that stuff so you don't have to yourself. All you need to do is pick it up and use it. But if you do have an interest in learning it, it's all here as well. Some members love that side of it. Others couldn't care less because you get your buy and your sell signals regardless as well. And Beyond Charts is a full-blown technical analysis package where you can overlay all sorts of different indicators. You can write your own formulas. You can backtest your own ideas. You can run simulations, all sorts of different things as well. But day-to-day, week-to-week, run your scan, look for your buys, look for your sells, protect your money from major crashes as well. Okay, so getting back to here, the 3 ways, okay, implementing the 3 ways for your portfolio to avoid the next market crash is number 1, just to reiterate here, the 3 ways. Number 1 is don't be in when the market crashes. You don't want to be there. You know, if the market pulls back, get out, protect, and live to fight another day, so to speak. Okay. You've got to have something to protect your money, whether it's something like we use with our leap timing indicator, the ATR trailing stop, or a percentage or something else. Overall, you've got to have something there and you've got to act on it every time, and then something to help you re-engage with the market when the market bounces again. Step 2, or number 2 of protecting, have an exit signal on individual stocks so you don't get stuck caught holding on to losing trades too long. Number 3, avoid topping up or buying the dip without an exit strategy in place on stocks that are falling, because they can always fall further. Losses are part of investing. You can't get away from that, but you want to minimize them as much as possible. Small losses are manageable. Big losses can be devastating. GA education may have bottomed out here, but right now it's kind of tracking sideways. So we want to see a breakout to the upside before buying it again. Otherwise, it's just too risky. To give yourself the best chance at profitable trades, you only want to buy stocks that are rising in momentum. There's a reason why they say that, that saying is so popular, the trend is your friend. It's true. So get into those stocks that are trending upwards and get out of the ones that are trending downwards. It's these crucial factors that have helped us grow our public portfolio so much over the years. Now, the reason that Gary started Share Wealth Systems was to genuinely help the average investor take control of their own money by following a simple strategy that's got years of outperformance already under its belt. It guides you on exactly what to do at all times, removing emotion and indecision from your investing. At the end of the day, you're going to care about your money more than anyone else is going to care about it. So rather than leaving it in the hands of some fund manager who overcharges and underperforms, we'll educate you to grow your nest egg more in the good times and protect it against the big market crashes. It's not something that we just give you and send you on your way and say, hope you do well. We're here to guide, help, support you, and coach you every step of the way. And we know that other companies charge $5,000 or $10,000 a year to be part of their inner circle and receive a lot less than the kind of ongoing education and support that we offer. $5,000 to $10,000 is probably still money worth spent if it was to protect you from a big market crash, though, right? Okay. However, we're big believers in keeping our systems at a reasonable price where investors get great value for the small price they pay for our service. So with that said, do you mind if I spend a minute to show you through the package we've put together to help you fast track the process to becoming a more successful and consistent investor, and ways that you can automate those 3 ways so you don't have to do it all yourself and go through that trial and error of finding out works for you? Well, what this package includes is pretty much everything that I've just shown you. Plus, there's a whole lot more. So let me break it down for you. So firstly, you'll get Beyond Charts Plus, which is just what we're in just then, the complete technical analysis package. There's a whole range of different indicators. There's fundamental information, scanning tools, industry watch lists, the Beyond Charts formula language and simulations tools as well, which Beyond Charts by itself is valued at $595 just as a standalone technical analysis package. But we also provide the portfolio manager, which includes the complete money management tool, the financial statement, the daily trade report, portfolio profit and loss statement, There's the equity curves for your portfolio as well. So much like I showed you with our portfolio where we compared it against the All Ords earlier, you could do that with your own portfolio and see how it compares against the market, or compare different portfolios against each other over time. The great thing is with the portfolio manager is that it's going to simplify all of these things and calculate all the positions for you, and then do all the reporting for you automatically. It updates every day. So it's really about taking the complex tasks and letting the system do the hard work for you, rather than you having to input a whole bunch of data and updating your formulas and things like that in a spreadsheet as well. So that by itself is valued at $9.95. Now, of course, the package we're offering today also includes all the signals, okay? So with that, you're always going to know exactly when to buy. You're always going to know exactly when to sell. And importantly, you're going to know when to get out of the market completely and protect your portfolio. This could literally save you tens to hundreds of thousands of dollars over your investing lifetime. And that's not an exaggeration. Think about how much you have in your nest egg right now and what it would mean if you lost half of that. Devastating, right? Especially if you're already in retirement or just the few years leading up to it, like I said before. Just one market crash avoided and you're way ahead. And not to forget how much it helps you grow on a rising market. It's really invaluable when you think about it, about how much it can save you over time. Okay. Now, as an added bonus, we'll also include the Retirement in a Weekend course and our Critical Concepts video course. These are investing courses from Gary that will show you how to avoid a mid-retirement crisis so you don't run out of funds during your golden years. Also develop a wait and win strategy that you can use for yourself, but you can also pass this on to your kids as well and set them up for life. Now, the wait and win, it's something that could literally put your children hundreds of thousands of dollars better off over their lifetime. Now, it doesn't have to be kids that are still in school children. It could be adult children, maybe in their 20s, that aren't quite ready to do buying and selling of shares, but could do a buy and hold and want to grow their portfolio much more than having it in, say, a standard super fund. And now there's the quasi super funds where they can do it within a structured super fund environment as well. There's also step-by-step guide on setting up your own investment plan and the templates to go with it. Now, financial planners can easily charge thousands of dollars for investment plans of this type of caliber, but we're including it as part of the package today because we feel so strongly that every single investor should have an investment plan that they always stick to. You want to take a professional approach with your portfolio, much like if you were going into business, you'd have a business plan of what are you going to do? What are your goals? Where are you going to be 5, 10, 20 years from now? How are you going to get there? And you would have it itemized, the targets you're going to hit along the way, the goals you need to make. So we suggest having that for your investing, and an investment plan is where you set that out, having it put to writing so you can refer back to it and see how you're going on your plan at all times as well. After all, a goal without a plan is simply a wish. Now, I just want to reiterate, got tongue-tied, that we really are here to hold your hand every step of the way through the entire investing process. So we offer all the ongoing education and support that you need all the way along. As I said before, we don't just give you a program, slap you on the back and say, off you go. We're here whenever you need us with unlimited phone and email support. We do fortnightly online user group meetings. You might have seen the What's Up with the Markets on the YouTube page as well. They're done by Gary. Annual live user group meetings in capital cities. We run live sessions where you can come along and meet and greet other similar-minded investors on a similar path as well. We help you with portfolio setup and suggest some brokers if you don't have one, and give you market analysis and training along the way as well. You're even welcome to come into our office in Melbourne if you're in the area, and one of us can take you through things personally, sit down beside you with your laptop and go through it personally. Now, that sort of ongoing education support could easily be valued at $19.95. As I mentioned, other companies that charge $1,000 per year just for this one aspect, and they don't even give you a system at the end. You get the education, but then you have to go and build your own system. With us, you get your full system that you can pick up and use from day one, plus all the education around it and the support along the way. Okay, we also provide the daily market data as well on stocks, ETFs, local indices, world indices, Forex and futures. even the Bitcoin chart if you're into crypto as well. We don't trade crypto, Forex, or futures, but the charts are there if you have an interest in those as well. So that's valued at $900 per annum. So if we add all of that up, it comes to a total value of $7,777, which looks a bit crazy with all the sevens, doesn't it? Now, obviously, we're not going to charge that, even though our members who've been with us for years would totally say that it's worth it. We just simply don't charge it. Plus, we also back it up with a full 30-day money-back guarantee. So you've got complete peace of mind that we're just as committed to your success as you are. And we're willing to put our money where our mouths are with that as well, with the 30-day money-back guarantee. However, before we go through the actual cost, can I just ask you a couple of quick questions? If all this did was to give you certainty in exactly which stocks you should invest in and when to get out without all the confusion and hesitation, would it be worth it? And if all it did was to grow your portfolio in a more consistent, less time-consuming way without spending hours doing loads of research, would it be worth it? And if all this did was to protect your hard-earned nest egg from major market crashes, just like it did for our members during COVID and the GFC, would it be worth it? Because let's be honest with ourselves for a moment. Like I mentioned before, how many times have you held on to a stock that you should have sold only to watch it fall further and further, and it cost you so much more than it should have? We've all done it, right? And that can be a mistake that costs you thousands and thousands of dollars. Hey, I did it with my portfolio, blew up my $25,000 portfolio. A lot more than what we ask for the once-off price of the system.